Welcome in, everybody. It's a Sunday. It's another live Q&A, and this one covers a lot of very interesting topics, and it grilled me on a few items. So we're going to talk about how to de-risk and how to DCA and how to lock in gains and how to do covered calls. And speaking of covered calls, can AI impact covered calls? We'll also dig into how I get to my 14% hurdle rate, i.e. I always say if you're not making 14%, you're drowning. We'll dig into that. And we'll talk about monopolies and de-risking and how to find tops and what to do with $1,000 a month and so much more. Let's jump in. And thank you to the mods that covered calls. Oops. We'll also do, we got volume, and none of this is financial advice. Just a guy on the internet who shares what he does. That's it. It's real simple. And shout out to Patreon too, who make all this possible every single day, every single week. All the questions come from you guys. So let's jump into the very first one. This is from Boy. Hi, James. Joined Patreon finally. I recently became a father, and I have a plan to invest some money for my kids. I don't feel like going S&P 500 or similar, as my kids will inherit some assets from us. I'm thinking about putting some money, $1,000 Australian a month, into Tesla, MicroStrategy, Bitcoin, Sol, and Jupe. I'm not sure how I should divide them. Please suggest, and God bless you and your team. Love from Australia. Very nice. So let's break this down. First of all, congratulations on the new family. And this is just an idea of a structure. And of course, do your own research, do your own things. But this is kind of what I would maybe consider doing. And as you know, I'm very big on narratives. So once again, congratulations on becoming a father and taking steps to invest for your children's future. It's wonderful you're considering a diversified approach. And actually, we'll talk more. You mentioned S&P 500 index funds. When we get to my hurdle rate, you'll see why that is so important as well. You have to invest in the top 1% of assets, and you have to invest in disruption and high growth. Absolutely key to getting ahead. And I'm a testament to that. So first of all, you could consider Tesla. I think at this stage, Tesla risk reward is bonkers. So that could be, and these are just examples, okay, not for you to do. I don't give financial advice, but Tesla would be 30%, would be $300 a month. Bitcoin, MicroStrategy, combo, whatever you can get access to, maybe 40%, $400 a month. And if it's tax-free, you can actually trade around these things very easily as well. Solana, maybe 20%. All the data I still see says this is the token of this bull run. It has been and will be. And NVIDIA, maybe 10%. Even though NVIDIA is very, very toppy, it still is a force to be reckoned with. And we saw it adding over 15% just last week alone. So let's talk about the key, though. This is probably the most important thing, is if you are serious about a DCA strategy like 1,000 a week, we have built a tool for that. And I'm going to walk through why it's important to have a system when it comes to DCA. So if you use DCAS for Bitcoin over the last couple of years, you would have 16.25 Bitcoin versus 13.5. And most important thing to see is the number of shares or tokens is here on the DCAS model. The spend, you would spend less and have more, which is hard to even believe, but that's how good this tool is. If you use DCA, you'd spend 210,000. If you use DCS, you spend only 189,000. And your ROI, most important, 289 using DCA, 415% using DCAS. Also, if you do it using MicroStrategy, same thing. You would have more shares using DCAS. You spend a little bit more money, but your ROI is also a lot higher, 250 versus 320. If you use DCAS on Tesla, you'd have 600 shares versus 450. You would have spent a little bit more, but again, your ROI is higher, 301 versus 254%. And I didn't tune this at all. I just used the default, drop the anchor, same DCA per week, and that's where we are. One other one, let's look at NVIDIA. This is an interesting case in point. Because NVIDIA has been on a rampage, what DCAS will do is it'll keep you kind of off the train during a rampage. So what's important here is if you look at DCA versus DCAS, you would have spent a lot less using DCAS. You also would have less shares. Instead of DCA, you'd have 3,655. DCAS, you'd have 2,867. But the key is the return on investment. Using DCAS, even though you spent less, your ROI is a lot higher, nearly 600% versus 377. So putting all these together in a quick table, the key is to have a process, have a system, have a basket of assets that are transformational. And you can see here the ROI delta across all of these different DCA methods, 44% higher on Bitcoin, 26% higher on MicroStrategy, 57% higher on NVIDIA, and 19% higher on Tesla. Yes, Tesla has sucked because it's down off the highs from 3 years ago. That's why it still beats it, but the results are not as crazy as the others. But that's also why we have this concept as well. Most important, remember the rotation. When you're thinking about you and your family, tap dancing shoes always. Bitcoin, crypto is very volatile. It goes through a bull market and then it retraces hard. So remember, as I say, pair trade of the decade and rotation. We'll talk more about rotation a little bit later as well, because that's so key, because there is a question regarding what to do with profits, where to put them. Next question is from DC 2024 regarding rule number 9, when fear is high, what's better? DCA'ing, but increasing the amount as the fear rises and the price drops well below the mean, or just sit on the cash. Wait and go huge when fear is really high and when the price hits what is probably close to the bottom, and no more than 2 standard deviations from below the mean. At the moment, I DCA and go harder when it makes more sense, but then I never feel that I have enough cash to use and what is hopefully the bottom. Note, I try not to mid-curve things, so I'd instinctively go for a simpler DCA option. Thoughts? Very good question. I like the way you're thinking. I like the way you're thinking a lot. So I'm going to first of all talk about fear and greed. It is a little bit of a flawed metric here. Fear and greed, it's fun, but flawed. So it does have limited range and it's oversensitive as well. The 0 to 100 can lead to exaggerated readings. You know, I do talk when it's down at 25. It's always kind of a good caveman way to buy, but it's not scientific enough for me to use. Even small movements of around 10% can cause drastic shifts in the index. Also, it's very laggy, so it's typically updated once per day, and some of the data is even more laggy than that, and therefore it's not perfect. It's also very subjective. It has subjective indicators and based on human judgment, which of course is always a problem. So I do believe fear and greed is flawed, but we do have other methods and you're talking about them too. Again, we just covered DCAS in an example, a mathematical process by which to optimize your DCA. Also, mean reversion, you did mention it. Here is an example of Bitcoin on mean reversion, not correlated to fear and greed, but an extremely precise tool by which to use. This is correct kind of 83% of the time on the 4-hour chart. So when you have big dips, look at those green buttons at the very bottom. When this happens, when you go outside that collar range, that's when you can safely buy hard. And always keep a little bit of cash, don't blow it all. And the corollary is also true at the tops, the red dots at the top outside of those standard deviations. So you're dead right. These are the two things that I would use to optimize when to DCA, DCAS, and in combination with mean reversion. It'll work very well for you. Now, next question. Hey, James, I understand that experience, time in the markets is a major factor here, as well as being in the top 1% of assets. However, are you able to give a run-through of the process you follow when it comes to determining when to de-risk a portfolio and increase cash allocations? You and this community are the best. Thank you so much. And let's get into my process. Sorry, little cough. So, we've spent a lot of time during the bear building to have a process so we know exactly how to de-risk, when, and why. So first of all, one of the first tools for de-risking, if we're talking about Bitcoin, is TABI, the top and bottom indicator. This helps us understand exactly when things are getting very frothy in Bitcoin and when to start de-risking. the second element of the process, and you notice there's a theme. We only build stuff that actually you need to optimize all of the stuff, optimizing DCA'ing, optimizing de-risking. Everybody is talking the right language, and I couldn't be more proud. But the second tool is for de-risking is profit-taking model, which we just released a week ago or so. And this is, again, another mathematical data science tool to optimize exactly per asset, how, based on your cost basis, based on your settings and your risk tolerance, how much to take off the table. Now, I love when you said the top 1% of assets, etc. But there is another aspect. You asked a question, when to go into cash. So I move hard into cash when I see things behind the scenes. An example would be 2019. I got wind of what was going on in Wuhan, and I knew it would be bad, and I basically de-risked everything. I normally do that at the end of the year anyway, so it was a perfect storm of I clear out the shelves of crap that I wouldn't buy at that point in time, move a bit to cash, and reallocate into faster horses for the beginning of the year. But the Wuhan thing had me an extraordinary amount of cash, which meant I could deploy on that one famous day in March where I shut the door, locked myself in the room, and deployed like a madman. You wait for these opportunities. Now, there's also the seasonality. I'm a little bit heavier cash now than I'd like to be. I'm probably like 10% at the current point in time. But it looks like we may not get our September dip. That's okay. We got a little bit of an August one. And I still have been DCA'ing, but I'll start fishing out other assets. But the most important thing is not necessarily to rotate into cash, but rotate into whatever the next best thing is. So if you imagine a horse race, I forgot to include a little graphic of that thing you see in the playgrounds where the kids have to spray water in this little hole, and these little horses go across this big wooden shelf. That's kind of what happens, because different horses run out of steam at different times. We saw that with NVIDIA at 128, 130, and we see it with other assets. But the idea is to rotate out of things that get toppy based on the profit-taking model and rotate into things that are undervalued and about to pop. And that is one of the last things that I'll ever build, hopefully in my life, is the rotation model, and that will be coming soon. We have a lot of meetings on that and the build out of that, so that's going to be next in the box, hopefully before the end of the year. But you'll be able to configure, if the vision works, exactly what you're in and what you want to move to, and then the optimal time to be able to rotate across assets, not necessarily to cash. You can rotate to cash for certain stormy times in the market, like before a war or before a C19 set type of situation. But other than that, it's more like a gradual transition from one to the other. I hope that helps. That's my 3-step process. 2 of the big steps are already built. Next is from Jasper. I'm going fast. We got a lot to cover. Jasper, I have MicroStrategy call options with long-term capital gains that expire in January. Given the implications of outcome of the election on the price of these options, should I consider closing the positions before the election results? Super interesting question. And my answer might actually surprise you. So first of all, I do believe Bitcoin will do well no matter what candidate wins, because we have institutional adoption and mainstream acceptance. We got the ETFs, and there's no stopping this train. And either way, no matter what happens, I do believe Bitcoin will continue to grow, because it is a tool to insulate the world from governments and political volatility, etc. And the ETFs, despite challenges over the last couple of months, they are maturing, and people are definitely deploying, and a lot more money is to come, I do believe. Now, Bitcoin is also, a hedge. BlackRock came out last week and talked about it being a hedge against governments and inflation and wars and everything else, which was quite profound. Also, I do believe one side will increase spending on things like proxy wars and maybe push CBDCs, which will drive price of Bitcoin up, and it'll also drive adoption of Bitcoin up. And this stuff is happening kind of here and also in other parts of the world. The other side will also trigger adoption in different ways. Either way, I see upside for both. So I'm still holding all my MicroStrategy. And in fact, I bought a week or two ago as well, bought even more. So from that perspective, I'm still very bullish on Bitcoin and MicroStrategy. And I would say, no matter what happens, Bitcoin will do well. It's kind of, it doesn't care. And either side, I wouldn't worry too much about it. Both are good in different ways. Will help. Next is from King's Forest. Does Tesla or any of Musk's companies run a risk of breaking monopoly rules? Seems like he's far ahead in so many things, but he could get slammed with some lawsuit or something in that regard. I like the way you think. You're dead right. But first of all, where do I begin? There's a lot of stuff to unpack here. And you know that there's been a lot of legal warfare against Elon Musk, against his companies, against SpaceX. They can build Starship faster than the government can move a piece of paper. Elon said that as well last week on the All In pod. But there are already so-called monopoly lawsuits and cases, repair and parts monopoly claims. Tesla's facing a renewed class action lawsuit in its monopoly on repairs or parts by its vehicles and not letting everybody else do it because you need special skills. Thank you, Andy, for coming too. The lawsuit claims Tesla coerces owners into using only Tesla service centers and parts, potentially violating antitrust laws. But if you know how a Tesla's built and how it's all digital, you can't exactly say, hey, Mike, the mechanic, can you fix my FSD computer, please? Thank you. Or open up my octa valve and find out what's going on. Again, it requires a very special skill set. And that's one of the problems. But the good news is Tesla cars don't crash. So there's not a lot of repair work to be done. Now, other stuff, superchargers, you could argue there's a monopoly there too, because their charging network is the best, fastest, most reliable. And that might come as well. Space is a monopoly. Nobody can touch them. Boeing can't hold a candle to them. Boeing can't even get a little thing to work. Anyway, or keep... I'm not going to talk about that. Market share. You could argue that's a monopoly too. It's basically BYD and Tesla. Duopoly if you want. Self-driving technology. Monopoly. AI. Monopoly. Freedom of speech on X. Monopoly. Blah, 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 blah. Yes, that's just the nature of it. But don't worry. Remember, I always say scared money don't make money. This is also and has been a monopoly for 2 decades. Google. Okay. Google is officially a monopoly. And here's what that really means. This is an article from Slate that just came out. And of course, there's been thousands of articles like this for the last 20 years. But when it comes to general search services, general search text advertising, Google commands over 90% of the market in such services. Google has maybe, some people claim, maintained its monopoly through extensive exclusive agreements with other tech companies, contracts that Google make with search engine on devices and browsers, who knows? And the ruling opens the doors for remedies, but I know that like the European Union have sued Google many times, they've sued Microsoft many times, they've sued Bill. So just think of, the best, winner takes most. It's the nature of the world. There'll always be not necessarily a monopoly, but a leader. And governments will always come after them. But they just get a smack on the wrist. So let's move on. Don't worry about it too much. But very good question. Next is from Don Quixote. Hey, James, Palantir has been on a run lately as it was included in the S&P 500. I'm in big profit and have a little more than 100 shares. Would you sell a little and take profit, sell calls, all-time high, or hold NFA from Germany? Well, hello, Don in Deutschland. Thank you for coming. What I would do here, just looking at the chart, there's a couple of things that pop out, and you'll see we're looking at basically IDSS here. A few things I do want to call out is the confluence model is about to flash a sell signal. That means we're getting very toppy. A lot of the buying for the S&P 500 edition, which was a surprise to many, has been done probably at this stage. So it should technically mean revert. Same thing at the bottom is mean reversion. And also the trend is about to flip. And these models are right 97%, 94%, and 100% of the time. So when you add all those three together, all telling you the same thing, odds are this thing will revert down from $36 back to maybe $30. But I did see, though, what is interesting, you can sell a covered call for about $5 right now, $35 strike, going out a few months. Do that, and that will protect you down to $30. Take some money off the table. And that's the key way. We'll talk more about cover calls in a minute as well. But that's what I would do. And congratulations on Palantir. Next question is from the Mr. Mountain Goat. I have seen and heard talks about token unlocks for Solana scheduled in 2025. Can James elaborate on how big these are compared to other unlocks and what the impact on price will be for Solana during this bull period? Thank you for all your works and efforts. You guys and girls rock. Thank you so much for coming. So I am the guy who has been fighting Solana FUD since 2021. Okay. And sometimes it gets really tiresome. People here, like you have, it's another one of these most hated assets. You got Tesla very hated and Solana very hated, and MicroStrategy for the longest time was very hated. Nobody understood what it was, but we did. But again, I just want to say it's exhausting when you get asked the same thing over and over and over again. But the good news is we have data to dispel the FUD that is perpetual, especially now. Everybody's trying to rip this thing down because they're seeing it as a virtual threat to all of the cryptos. So this is the big unlock you're talking about in 2025. It is 1.75 million SOL. It's the bottom line there. Scheduled to unlock on the 4th of April, 2025. All right. 1.75 million SOL equates to about $210 million today. Let's have a look at what that actually means in dollar terms. So if you look at the daily volume on Solana, it's $1.7 billion in a sleepy summer. That is 8 times in one day the volume of the unlock. 8 times, and it'll be a lot. It's going to grow a lot more as volume comes back now that we're out of the actual summer itself. So bring this in another bit of perspective, because I always hear the FUD of, oh, the inflation is really high and everything else. Well, first of all, you're getting 8% staking rewards on your Solana. And this is the inflation schedule. Current inflation is about 5.032%. Got this from the official site. Initial inflation rate was higher, yes. Annual taper is down 15%. Final inflation will be 1.5%. Now, let's compare that to another name. Just pull one out of the air. Oh, Cardano. Cardano's been around 6 years longer, and the inflation is the same per the InvestAnswers Crypto Compendium, which gets automated data feeds and calculates it for us. So I just thought it was a funny coincidence that the inflation is exactly the same as Cardano, but Cardano's been around since 2015, and the ICO for Solana only took place in 2020. So I thought that was kind of interesting. So again, put things in perspective, do the calculations, and again, we are the Fud Fighters in here, and I've been fighting FUD my entire life, so don't sweat it. All right. Just everywhere you look, it's like, oh, all the users are bots and all this and all that. And there's going to be a big unlock and FTX is going to do this and Alameda is going to do this. And just look at the fundamentals. Look at the breadth of dApps. Look at the technology. Look at the speed. Look at the cost. Look at the fees earned. That's a very good one to look at too. And by the way, when we analyze tokens, we look at 69 different metrics. Not one, many of them. And we benchmark every asset against every other asset too. So that was a Fud Fighters. Can anybody guess what my play on words is there? Yes, I hope so. Next question is a very important question from Steve H1. Hello, James. You often mention if you were not getting 14% a year in your assets, your future self is getting poorer. I love the way you phrase that. I assume this consists of real inflation plus the money printing impact on the US dollar. In an effort to accurately convey this message to family and friends, can you provide a simple explanation of what composes this number, e.g. X% real inflation, Y% money printing, etc., and especially help us understand your calculations on the impact of money printing. And thanks for what you do for the community. I love it. And I love the way you anchored on the 14. I'm going to break it down, slice it a few different ways, because it's nice to have kind of attack vectors to support your point from different angles. First of all, Chapwood Index. The Chapwood Index is there's the other one that I sometimes refer to, but they don't like when you talk about their stuff without filling out all this paperwork anyway. But the Chapwood Index here is a very, very important index, and it shows you the actual inflation for different geographic locations. Here you will see over different years, 2022, 2023, etc. for New York, Los Angeles, Chicago, Houston, Philadelphia, Phoenix, San Antonio. So if you look at places like San Diego, 12.3%, San Jose, 12.4%, etc., that's the Chapwood Index, and you can see it's pretty frightening. And the averages are also very frightening, some over 13%. And that was just a quick snapshot of some of the top lists. So inflation itself is very, geographic based, because it ties in cost of labor, cost of real estate, all that type of stuff. The other key factor too, and this is more global, not just the US, and the other, probably one of the most easiest ways to think about it, and then I'll sum it up with what the whole cocktail looks like. But Saifedean basically talks a lot about using 14 trillion, 14% per year. So the global historic average fiat, global all fiat currencies face an annual dilution of 14%. Global money supply, $100 trillion. It's now going higher. Global wealth, 400 trillion. That means a quarter of all wealth is in fiat. And every year humanity loses 3.5% of global wealth, or 14 trillion, to finance government parasites, wars, monopoly banksters. His words, not mine. I think everybody's great out there. But the point is, the cost of fiat is everywhere. And that fiat money dilution is an average of 14% over the last 60 years. Okay? Every year, 3.5% of all global wealth is taken away. That's why the top 1% are getting richer, because they're closer to hard assets and they're closer to the Cantillon machine. Real simple. Now, the other way to think about it, I'm kind of cutting this 3 ways for you all. And this one you can watch very simply yourself. You take a simple little chart of M2 money supply, then you look up the CPI, and then you compare that to GDP. And overall inflation, CPI, measures how much price changes for things like food and services go up. But the way the government measures it is not like the way the Chapwood Index measures it. In addition here, we know how big money supply growth is. Money supply growth shot up 40% in the US since 2020. 40%. That'll trickle down and debase your dollars over time. Much of, probably 25 to 30% of it has happened already, but more will come. And more will come too, because the money printer is never going to stop. The black line in the chart here is M2. The blue line is CPI, and the red is GDP. So what do you notice? One, GDP is not growing anywhere near as fast as CPI, which is a problem. And the only way governments can continue to grow the GDP is to pump the M2. And once you pump the M2, the blue CPI follows. It's that simple, ladies and gentlemen. So there's 3 ways you can take to your friends and family. Holding fiat will crush you. Think 14% per year. Yes, you might get, say, 4% return on it, but that's taxed short term, so you actually get a far less return. And it's scary. And just look around. Look at the cost of things everywhere. Look at cost of education, cost of medical, cost of car insurance, cost of blueberries, whatever you want to look at. It's all bad out there. Anyway, thanks for the question. Steve, Mataroo. First of all, James, thank you for your dedication and support. My pleasure. We have just had the yield curve uninvert. That typically signals a recession, and the Feds are set to begin rate cutting with September 18th FOMC in 3 days. Yay. Typically signaling they now realize something is broken. And I want to buy more Tesla shares, but I'm hesitating due to these dynamics. Is it your opinion that even in a recession, Tesla will outperform because you consider it a disruptor stock, and that disruptor stocks outperform and shine in recessions? Yes. But let's talk about exactly what's going on. First of all, and this is a common fallacy, people wait for the government to tell them there is a recession. So it's like they wait for the government to tell them what the inflation price is, or they wait for the government to tell them what the BLS numbers are for job losses, and then they revise it down by 1 million 6 months later. What is it? There are lies, there are damn lies, and then there are government statistics. Something like that. Sometimes I get these things screwed up. But let's talk about the industries in vicious recessions right now. Okay, vicious, brutal, depression-level recessions. Residential real estate, totally in the pooper. And this includes all the people in the ecosystem, the mortgage brokers, the realtors, the appraisers, all getting brutalized out there. If you are in any one of those industries, drop a comment below and let me know how bad it is. Commercial real estate in the total pooper, big time. Manufacturing, absolutely worse than the global financial crisis. Automotive industry getting absolutely smashed. You mentioned Tesla. They are being brutalized, but they're surviving. And they're actually keeping their head at water. Look at some of the videos online from car dealerships, etc. They can't shift metal. They are literally giving $20,000, $40,000 off cars just to get them off. And they have models going back 3 years sitting on the lots. It's a disaster for car dealerships. It's a disaster for legacy ice makers. And it's a huge problem. Then you got your media and entertainment industry also in a world of hurt. These are just a couple, like the top 5 industries that are deep, deep in recession right now. So if you think for a second a recession is going to come because the Fed is going to cut rates, no. We've been in a recession for a long time. And the most important thing to understand, if we're not for the crazy government spending, even though you're not seeing it directly in your pocket, the government is spending a ton of money. All right, 25% of US GDP is government spending. Okay, yearly federal spending, 6.24 trillion, or nearly 25% of the US economy, or nominal GDP. And this is the simple little deficit chart. Even though it looks like, we have a huge spike for C19, etc. But guess what? The spending continues. Okay, the government has spent this much as a percentage of GDP when they're trying to get the economy out of a recession. The economy is in a 4-year recovery, and the money printer is still going with bank bailouts and everything else, and it's about to go into high gear. And there is no crisis. There are, I would argue, many recessions, but because of the extreme government spending, they can play with the numbers, say, oh, look, we had GDP growth of 2.2% last quarter. Woohoo, party on. You rip out the $6.5 trillion of government spending, your GDP goes into the toilet real fast. Super negative. And that's the game. That's why I make videos. That's why we Bitcoin, because the spending and the debasement and all the nonsense out there, people are just not aware of. So, great question. I hope it helps. Sorry if I threw a bucket of cold water on you. But yeah, we are in many recessions all over the place. Next question, which is kind of cool. This is MH48. I have been significantly supplementing the income from my day job with premiums and selling covered calls over the last year, thanks to lessons from this community. That's the way. That's how I began in the 90s. CCs all day long. And glad you've nailed it. You have mentioned you see AI disrupting much of what you do in trading. Is income from covered calls something I can count on, being able to use going forward in the long term, or will AI take this away in the near future? And what are the main ways AI will hinder things you have traditionally done as a trader? So this is really a very profound question. And I've been thinking about this hard since 2021, 2022 especially, when all the AI stuff. But there is hope. I'm going to break it down into 3 separate parts to make sure everybody understands. So all hope is not lost. we are still safe from AI as long as we position ourselves the right way. So first of all, the impact of AI on options trading. Like AI and machine learning are getting better and better at analyzing market data, pricing options, executing trades. And this could lead to more accurate options pricing. By the way, in the 90s, I arbed options. I'd find mispriced options and trade them against each other. That's kind of my whole thing. We're not going to see as much of that opportunity anymore with AI. So that's very important. Also, we'll get faster or more precise hedging and managing of risks. Yep. And we'll get automation of much of the trading process. So that's what AI is going to do around options. So they will be priced better, especially for deep liquidity type options. Now, the big question you have is, will AI eat our covered call lunch? And the answer is good news. Despite all the advancements, covered calls will likely stand a very good chance and still be a very good strategy for individual investors, because it's a simple strategy that does not rely on market inefficiencies, and income comes from limiting potential upside, not from mispricing. It's so important. And investors can still earn premiums from selling options even if the price becomes more efficient. So this is all a goodness for us. And remember, when we sell calls, the beauty of selling calls is we're selling time. We are kind of leasing out our time to somebody else. It's like a greater fool. We're finding something that is either priced too high, or we see a top in an asset and we find some sucker to buy our time short term, which expires worthless 90% of the time. That's the whole game. Real simple. But the third part of the answer to your question is longer term AI impact. Will it smoke us? Well, the strategy remains useful. AI could impact it in a couple of ways. It could mean slightly lower premiums, so we're not getting as much juice from the squeeze, more competition, more people are learning the game that we've been doing for a long time, and AI tools could help retail investors choose better strike prices and expiration dates. I can look at a sheet of 400 numbers and I can find the two best to trade off each other in a second because I've been doing it for so long. But now the average retail will be able to use tools to be able to identify such opportunities automatically. And that'll make me redundant. So, but we can still do it, okay? Because we've got different tools like mean reversion and all that type of stuff will really help us stay ahead of the game. And remember, you sell calls on spikes, you sell time, you sell short term, you sell at or out of the money. Real simple. And I do believe it's not going to go away. Thank you for that. And helping animals, best part of the week, Baron von Screech, Eastern Screech Owl. Isn't that a cool name? Baron was hit by a car. Unfortunately, he had his eye removed to maintain his health, but he bobs his head from side to side and he focuses his eyes and ears that way. So he's at the Schlitz Audubon Nature Center, and we help provide for care, food, and shelter. And he's super cute. So awesome. And don't forget, we do have our investor profiler quiz, so you can learn who you are, what your strengths are, what your weaknesses are, which legend you are like. Are you a Warren Buffett or a Peter Lynch or a Kathy Wood or whatever? And it's a free, fun, game-changing quiz that'll take 2 minutes of your time, and it'll also help you do the most important thing, which is identify your blind spot and your weakness. Tomorrow, DCA, 7:40 a.m. with the team. CTO is going to be moderating tomorrow, I think. I hope he's up. And we'll be there with Mando and, of course, Marty as well. Cover all the news. And don't forget to hit the like and subscribe if you want to survive this future of AI, which that was a story today. Let's do some questions live from the audience. And thank you, everybody, for coming. Thank you to the mods in the chat, keeping us all safe. I know there's questions coming in, but I don't see them yet. Hold on. Questions. Hello, questions. Well, I'm going to go fish one out. They normally get sent to me. I don't see any. I'm going to just talk about Mark here. He said, Mark Beyond Mind, I appreciate the knowledge you share with us. Knowing RWA will be used in all markets in the near future, or are there RWA tokens that show huge potential? Which tokens are you monitoring? I haven't seen any great shakes yet in this area. There's a couple of interesting things happening, but not a token structure that I would touch that passes the, the crypto compendium score sheet. I'm gonna ping someone here. Any questions? Because I don't have them. I know they're probably, oh, here they are. Got them. Thank you. Sorry for that little delay in the internet. Let me see. I am Colt. Did you watch UFC at the Sphere? No, I didn't, because I was preparing this. Sorry, I had no time. I was running low on time, and but I heard it was a spectacular scenic event. Next, Charles Kincannon. Difference between Lilo and profit-taking model. The profit-taking model is like 6 different data science components that feed off elements like the Lilo to come up with estimating where the price will go and how to optimize how much profit to take based on your cost basis, based on your risk tolerance, based on your price targets. That's kind of, there's no difference. And in fact, we've bundled the Lilo in the profit-taking model. So if you're buying Lilo standalone, you don't need to. It's already included in the profit-taking model. Doc Intern, before the October 10 Robotaxi event, when is the best time to switch from MicroStrategy to Tesla in a retirement account? Also, what a fantastic F1 race today. You're what's it called? A spoiler. I watch those things on a recording when I get time, sometimes weeks later. So who knows what happened? We have to look carefully at the pair right now. That I think it's 0.7 to 1 is when things kind of get interesting. MicroStrategy and Bitcoin have been lagging Tesla. Tesla's been running faster since 2 months ago when I talked about pair trade of the decade. But we don't know. I do believe, even though the Robotaxi event will happen, I don't think it's going to melt the faces of Wall Street because they don't have a clue about what this actually means for the world. So it'll take them a long time for the penny to drop. I still do believe Bitcoin, MicroStrategy will outperform Tesla through the end of the year. What happens in 2025, we have to see closer to time. So think about that ratio of 0.7. I think it's, let me check the ratio right now, actually, as we speak. I think it's about 0.6. Hold on. Pull it up. Yeah, 0.6143. When it starts getting to 0.7, that's when you need to think about what happens. But I do believe from here, MicroStrategy should outperform Tesla through the end of the year. That's record that here at Bookmark it. B-Man63. Stay hard and remember, FUD folks are mostly angry or resentful because they don't realize you have something they don't. Exactly. I haven't seen toxicity and negativity and hatred out there as bad as the bear market. It's really bad. I had to block about, I get trolled by a certain army. I had to block about 250 of them this week. They're very angry, very angry. And the most important thing about me is I use data to make decisions, not emotions. I might get sad about an animal or something, but when it comes to investing, it's all data-driven decisions. Everything we do here is data-driven, and that's a key lesson for you all. So B-Man, you too, stay hard, buddy, stay strong. And thank you for your super sticker, CERN Dragon, Signal 103, Linda Hoon, Anglo Blackson, Andy, Moto89, Viciously, and Johnny God Candle. Johnny God Candle, can you bring us a God Candle, please? I know people would like that. Let me check on if Bitcoin is pumped. It's Sunday. Sunday's normally pump day. It's 60K, and there's not a lot of volume. So we may not get a huge pump tonight, but who knows? We'll see. Depends what Asia will do when they come in around 5 hours. Thank you, everybody, for coming. Appreciate everybody. Hit the like so other people can see this stuff and learn and get smarter and find their life raft to escape the matrix. Thanks, everybody. Thank you to mods in chat and everybody. Good night.